You guys recently put out at ARC a brand new monthly update for Bitcoin, and you also talk a little bit about the merge.
The cost base and the supply starts to shift. When you have that crossover event, it's very reliable for suggesting a general area of a bottom. Let's talk about the merge. It imposes tail risk in the whole system, but transition from proof of work to proof of stake, we expect that narrative to be very in favor of Ethereum.
Is it just that the macro environment is kind of the most important thing right now?
The macro has become extremely, if not the most valuable source of information for determining Bitcoin and crypto price action as well.
When you begin to look at how derivative traders are handling the merge, how are traders actually playing this? All right, guys, bang, bang. I've got David here. David, you guys recently put out at ARC a brand new monthly update for Bitcoin, and you also talk a little bit about the merge. And I thought a great place that we could start was some of the on-chain analytics, which you're very, very familiar with. And when we go ahead and we take a look at these on-chain analytics, you can see that the 200-week moving average continues to serve as kind of this great point of support for Bitcoin's price. Talk a little bit as to why this is so important and why you guys continue to evaluate this.
Well, you can look at it on through several lenses. It's in essence a 4-year trend, related to the halving cycle, which is hypothetically a very important time horizon for Bitcoin and therefore all crypto. Historically, the first instance of the 200-week moving average was around 2015, I believe, and it has marked reliably bottoms for all the cycles in Bitcoin so far, and including major crashes like the COVID meltdown in 2020. So it's a very important, although technical metric, a very important metric for us to keep just track of a general status of the overall market structure and primary trend.
And then when we look at something like the Bitcoin investor cost basis, one of the things that's fascinating to me is the investor cost basis was actually higher a couple of months ago, but it's trended down as the price has come down, and Bitcoin still sits above that current investor cost basis. Talk a little bit about the importance of that serving as support, and also that it is a moving target, right? It doesn't just kind of always go up. In these situations, it does go down, and why that's important as well.
Right, so the investor cost basis is calculated as follows, right? You take realized cap, which is the general cost basis of the market, meaning you aggregate all coins at the point where each last moved or was last bought, right? And then from that, you subtract thermal cap or thermal price, which is in essence the cumulative sum of miner revenue through time. So what you're basically doing is capturing the actual delta in all moved coins and subtracting miner activity out of the equation. And what you're left with is actual investor cost basis, which, if you see the graph there, is reliable for marking bottoms throughout the history of Bitcoin. Now, importantly, we have touched that threshold twice in the last few months. It's currently at 19,000 and change. So it's very important to us from a first principles and also a battle-tested, backward-looking basis to determine a potential bottom for the cycle, given that investors would like to defend that level severely, given its importance.
Got it. And then if we look at the long-term versus the short-term cost basis here, those seem to be crossing over. And I know that you guys call out in the report that tends to mark a cyclical bottom.
Yeah. So sometimes you want to look for specificity in terms of timing on when to, let's say, look for the bottom or whatever approximation to that. So I'll first go through explaining a little bit of what determines a short-term holder or the short-term holder cost basis and the long-term holder equivalent of that. Long-term holders, or the coins of that cohort, are basically the Bitcoins that haven't moved in 155 days or more. And conversely, short-term holders are coins or supply that has been moved in the last 155 days. Now, this number is not arbitrary. It's actually quite important given the history of Bitcoin. There's some statistical analysis that has been done on the metric that determined that 155 threshold, and it varies from analyst to analyst. Sometimes it's 140. I've seen iterations on 120, but for overall, that 5 to 6 month time horizon is very important because historically, the probability of a single coin moving after that 155-day threshold drops severely to, let's say, less than 3% overall. So dormancy of coins in Bitcoin have a Lindy effect, and that Lindy effect goes exponential after that 155-day horizon. So what we do here is determine, okay, we have our respective supply cohorts, long-term holder, short-term holder, and then we assign a cost basis to each. And what we found, going back to the 3 last major cycles of Bitcoin, is that whenever the short-term holder cost basis, which is usually higher than the long-term holder cost basis, because it's packed with speculators and that sort of market actor, when that short-term holder cost basis goes below the long-term holder one, it marks a very reliable bottom cyclically. Now, our assumption from first principles is that this happens because the market has reached an equilibrium between speculators and actual long-term holder market participants, and also the cost base and the supply starts to shift from short-term holder activity and holding into the long-term holder bracket. As you can see in the chart, when you have that crossover event, it's very reliable, not only for suggesting a general area of a bottom, but also like precisely picking out timing and environments where you can, upgrade your bullish conviction. Now, we're matching this chart to the following one, which would be the long-term holder supply, and we're already seeing this take effect from another perspective. So what you're seeing here is the long-term holder supply, which is about it's about 70% of total outstanding supply today. As of the publication of the Bitcoin Monthly, it hadn't reached all-time highs. It's now at brand new all-time highs, which is increases the conviction overall. Being the supply getting squeezed, getting illiquid, and becoming even more inelastic. Now, going back to the crossover event at the publication of the Bitcoin Monthly a few days ago, that number, the delta between short-term holder and long-term holder, was about $2,500. Now it's about $900. So it's coming up fast.
When you think about this long-term holder supply, we continue to see it reach close to, if not all-time highs. We're closing in on 14 million Bitcoin being held by long-term holders. Obviously, only 21 million ever. There's about 19 million or so that are out into circulation. Is there a point where there becomes concern about Bitcoin being too illiquid? Like just nobody will spend it and everyone's just holding it long-term. And so like the number could get too high? Or is it just classic number go up technology, and the more people are holding, the less liquid the market, the more increase in demand, it leads to a price increase in the future? This episode is brought to you by Ledger, the best crypto hardware wallet. Everyone's heard the phrase, not your keys, not your coins. And that's more true today than it's ever been. Ultimately, a value proposition of Bitcoin and cryptocurrencies is self-custody, where you get to retain ownership over your digital assets. That is what Ledger specializes in. They've got multiple pieces of hardware, and they also have the Ledger Live mobile app, which makes it seamless to not only retain control over your Bitcoin, but also allows you to interface with exchanges, lending platforms, and other types of software products. If you're interested in upping your self-custody game, go check out Ledger today. Shop.ledger.com. Again, that's shop.ledger.com. Go check them out and start doing self-custody. You'll thank me later.
There's some truth to that latter statement, but regardless of anything, we expect a general equilibrium in the market between Several factors. One is issuance being less and less over time. We all know that part. So therefore, the asymptotic curve in total circulating supply over time. We all seen that chart. Very familiar with that. But most importantly, other factors are, show some interesting signals. So, for instance, there's less issuance coming into the system, but there's been less coins being lost because they're more valuable over time, right? So that increases a little bit the liquidity of Bitcoin overall. And on top of that, both illiquid and long-term holder supplies are increasingly. So basically, as this, you're having less issuance over time. In addition, you're having less lost coins, so that increases a little bit the overall number of coins that could be traded at any given time. But on top of that, given that Bitcoin is more valuable, illiquid and long-term supply are also being increased over time, given that Bitcoin has more value historically. So the market is actually noticing that. They're losing less coins, but they're saving them instead, which is a very important observation that I think most people are not aware of.
And then if we go and we look at the ETH BTC trading pair, you guys explicitly call this out as having outperformed Bitcoin. Talk a little bit about the trading pairs in general. Why is this one so important? And then what is the significance of it having outperformed something like Bitcoin?
Yeah, so let's talk about the merge, despite that the report is called the Bitcoin Monthly, right? The impact of Ethereum in the overall crypto market and therefore relative price action to Bitcoin is pretty much uncontested right now. And what we've seen, as you see in the chart there, is starting in more or less 2021, a trading range has been established in the ETH BTC pair and hasn't not left that trading pair so far. Now, the upper bound of that trading pair is very near the all-time highs seen in at the latest 2018, I believe. So we're watching that breakout in case it happens. In terms of the merge as a narrative and also a fundamental event for the history of Ethereum, if of course it imposes a tail risk in the whole system, but expecting success on the transition from proof of work to proof of stake, we expect that narrative to be very in favor of Ethereum and therefore overall crypto sentiment and the technology, the blockchain technologies as a whole. So we're keeping an eye on that. There's a lot of talk of the merge being a sell the news, or in this case, sell the event. So we're keeping a close eye on that, watching how price action behaves relative to such an important occurrence.
When you begin to look at how derivative traders are handling the merge, it's always fascinating to see, like, what is the market doing? We know the merge is coming. We know that people are talking about it. We know that it is going to create change, whether you think it's a good change, a bad change, whether it's going to prove the point of the critics or the proponents, like change is coming. How are traders actually playing this?
So you can see, but Ethereum is the most hedged asset in the crypto market right now, and that's unquestioned and also not surprising. You can see it both in the futures market and the options market. So in terms of the futures market, you have backwardation, which is extremely uncommon for Ethereum and Bitcoin as well. Most of this is the assumption is especially large traders are hedging their position and selling contracts and buying spot, therefore producing backwardation in the asset, a major backwardation. In terms of options, open interest in that market cohort is at all-time highs, even valued in Ethereum. Forget about dollar valuation. So in terms of Ethereum, you see the green line in the chart there, it has been extremely consistent, right? You pretty much see it go up and then slightly down as expirations amount over time since 2020. But since January 2022, you see a steep increase in Ethereum's open interest, as the merge gets priced into the market structure and the general sentiment in the options market.
And if we stay on this topic for a second, obviously the merge is something that the proponents would look at as a positive catalyst, but there's been some negative catalysts as well. I had somebody on the podcast who is an attorney. He was talking a lot about First Amendment and things around Tornado Cash, and that brings us to kind of these OFAC sanctions and some of the tools that are being used to address whether it's in the DeFi world, but even a concern that maybe it will come for privacy. Maybe it will come for even in the Bitcoin community. Like, how do you all think of these OFAC sanctions and their efficacy in tamping down maybe some of the excitement or use of these technologies?
Certainly a concern. I think fungibility, privacy, and therefore fungibility is, I believe, one of the major concerns regarding all crypto. And of course, it applies more to Ethereum, given that, let's say, an OFAC sanction can apply to major staking pools in the system that have to comply with those sanctions. But it still applies to Bitcoin in the sense that UTXOs can get blacklisted, and therefore you can see a goldification of it, where certain coins that haven't been involved with nefarious activity could be deemed untradeable, especially under US regulation, and therefore Bitcoin uses fungibility, right? So those coins or ETH or whatever lose value, right? So instead of trading at market value, you can see them trading at 10% discount or whatever the market assigns to that. So we're keeping a close eye on that. We are, especially as the merge, because the transition to proof of stake does increase that risk, especially for Ethereum, regardless of being a risk for all crypto.
And as we look at this, the piece to me that becomes the most interesting is you specifically called out centralization, and the ability to resist some of this is a test for centralization. How do you guys think about, is there a line in the sand, hey, you have to be this decentralized? Is there a way to measure centralization versus decentralization? Or is it more so you try to evaluate it given the information you have, but there's no right answer?
There's great nuance on that, because you have several dimensions of decentralization that you have to consider, right? You have ownership as one, which I think it's overstated, meaning what if a single entity owns a lot of Bitcoin or ETH or whatever, and then dumps on the market? Still, at a protocol level, it has no effect, right? It only has effect on price activity and the market as a whole. On a protocol level or a game theoretical economic level, it's more concerning. So you have to look, ultimately, I think, so far, we have some research on that coming up in a few months. But ultimately, I believe that the cost to run a node is the most basic and yet important or fundamental metric to determine decentralization. This argument comes from Puell's stores, and I believe it's crucial to determine the possibility of a network getting attacked at a protocol level. Why? Because the cheaper the node, the easier to combat an attacker with a lot of capital, right? Or hashing power or staking power in the case of Ethereum soon. So we have research on that coming up in the next few months. So we'll let you guys know as that publication approaches.
Awesome. The last thing that you touched on in the report, which is kind of the talk of all of financial markets, is the macro environment. And inflation continues to kind of accelerate. The Fed seems to be relatively ineffective in getting inflation down, although they are creating tighter financial conditions. What is your read, or why include this in the report? Is it just that the macro environment is kind of the most important thing right now, or are there other considerations as to how maybe the macro environment and inflation interact with Bitcoin or cryptocurrencies? This episode is brought to you by 8 Sleep. Good sleep is a game changer, and the 8 Sleep Pod is the best sleep machine. I sleep on it every single night. A great night of sleep allows you to be healthier, be more rested, and have more energy throughout the day. And on the brand new 8 Sleep Pod 3, you can sleep as cold as 55 degrees Fahrenheit or as hot as 110 degrees Fahrenheit. That's the secret of thermoregulation. Better sleep, better energy. Get yourself an 8 Sleep. You can go to 8sleep.com/pomp today to go ahead and get $150 off your order. 8sleep.com/pomp. Not only do I sleep on it every night, it literally changed my life, and I begged the founders to let me invest in the company. 8sleep.com/pomp. Go get yourself an 8 Sleep Pod and get a better night of sleep.
Yeah, it's important to have the macro session. Like you can argue with high conviction that the macro as an overall signal has become extremely, if not the most valuable source of information for determining Bitcoin and crypto price action as well. This since COVID, the COVID meltdown, March 2020. This was a period where most of the price discovery of the asset or crypto asset, especially Bitcoin and Ethereum, and therefore through correlation, algorithmic trading and all that, crypto as a whole. This was the moment where institutions, especially US institutions, starting to participate and partake in huge amount of the price action of Bitcoin on a day-to-day basis. This hasn't stopped. That's why you've seen the correlation. It pretty much tells you what's the how much of the change of one asset is being impacted or inferred from another asset. You've seen this with Nasdaq and S&P being highly correlated, analyzed versus Bitcoin and Ethereum since COVID. So we're keeping an eye on that. In the general context, the narrative is pretty much the same.
As you guys look at the home inventories, you've called out that it is indicating a recession. Talk a little bit about the idea of a recession. Obviously, we have some folks, whether it's at the central bank or in politics, that say we're not in a recession. Look at the labor market. Look at other data points. But then folks from the finance market, they seem to be much more convinced that yes, this is a recessionary period and there could be more pain ahead. How do you kind of just think through this?
Well, that's we entitled it, we named it, the Fed is between the rock of inflation and the hard place of recession, right? There seems to be on a monetary policy level, there seems to be no way out of either inflating prices and crashing the market and, stagnating growth severely in the economy. So, sorry about that. So it pretty much determines Powell's decision, who seems to be evoking Volcker severely in the last few months. So seems to be very much with a high intent of tempering inflation, even at the risk of having negative growth and therefore a very severe recession. We believe this is the most bearish case for Bitcoin at this point. Despite you've seen the on-chain metrics and a few technicals, we are severely oversold on a cyclical level. Despite that, the correlation between equities and crypto is so severe that we stay cautious on what the macro and therefore CPI prints and Fed meetings determine in the months going forward.
And as you think about Bitcoin's performance so far, is it holding up compared to the macro environment, or do you feel like it's kind of suffered at the hands of the Fed just like every other asset? And if the Fed continues for another 12 months, we should expect more pain in the Bitcoin market? Or how do you kind of think about that relationship moving forward?
One scenario is just chop until, let's say, next year. Pretty much looking for peak inflation, right? Statistically, equities bottom exactly or a month before peak inflation, right?
Mm-hmm.
So that's a major event we're looking into. But it's still up in the air when that happens. A lot of macro implications going into that and how the CPI is calculated. There's a lot of debate on that, of course. And on top of that, how how Powell determines risk on and risk off environments going forward. Now, interestingly, specifically for Bitcoin, an interesting data point that we found on a 4-year basis, if you take a CAGR of that, meaning a compound annual growth rate on a 4-year time horizon, for the first time, Bitcoin, after being between, let's say, 100 and 200 and change percent range for about 6 years on that CAGR, that dropped this year for the first time to between 30 and 100%. So this was expected to some extent, meaning Bitcoin, even the price is an S-curve. So you're going to have diminishing returns. So you're going to increase it at an diminished rate. It seems to be, but for the first time, we're noticing this year in terms of overall performance metrics, CAGRs, Sharpe ratios, etc. Bitcoin's growth still increasing, but at a diminished rate. So I just thought that was interesting overall.
Yeah, it's absolutely fascinating. When you guys put these out, where can people find the monthly reports that you're going to continue to do each month?
You can look for them in arc-invest.com. We have a dedicated crypto section where you can pretty much download and subscribe to the Bitcoin monthly. We have upcoming activity in that section in the next few months as well. So check in from time to time.
And then where can people find you on Twitter if they want to follow up with some of the stuff that you said here or get more information that you continue to put out?
My handle is DPuellArc. DPuellArc.
Awesome. Well, David, listen, thank you so much for jumping on real quick. These reports are, they're very fast to read through, but they're incredibly high signal. So I appreciate you and the ARC team continue to put them together. I enjoy reading them. I know many other people do as well. And they just give a great kind of understanding of, hey, here's what's going on in the moment over the last month. And they're kind of these great check-in points. So if anyone hasn't gone and downloaded them, I highly suggest you do that. Follow David on Twitter, and then we'll talk again next month.
Perfect. Thanks for having me.